Hey everyone, Nick here. This is a lesson on covered calls. It's an application coming from a question. Thanks for the question, by the way. Thanks for sharing the information on it. You shall remain anonymous, but the idea is pretty cool. I will use it to teach a lesson on covered calls. So there are many ways of doing these. These are my set of rules, and this is most definitely, please, this is definitely not a trade alert on Intel or a way to trade Intel or anything. I'm answering a question. The person that asked owns shares on Intel. Price point was 51.40. I'm rounding a little bit. And currently the price is slightly below that. And they said, okay, so how can I put my asset to work and sell a covered call? That's essentially what they're doing. So I'm going to give you my rules on selling covered calls. But first, let's define what a covered call is. This is Intel chart. Technically, let's talk about it first. Also disclosure, I am long Intel and shared it in the chat room and with the email recipients. So I got the move that I wanted. My thesis was it gets no respect, it's priced cheaper than banks, and it's bigger than NVIDIA, AMD combined twice over. So it gets no respect. So that was my thesis. Went long and we got this move. So I went long differently. They bought shares. I chose to buy calls for December options, and I got this move. So my profits came a lot faster than somebody that bought shares, and I locked my profit via this same strategy, and I'll share it with you in a second. So the questions that they had, how do I do the cover call, and how do I, one, choose which time frame I do it for and what level? That's really the two key things. How far out in time do I sell my call, and at what level do I sell my call, and kind of like what to avoid things. So let me first tell you that Intel has a failing point right here. It was support, and then they failed, and they tried to fill the gap. They started filling this massive earnings gap. They got into the middle of it almost. They hit the wall. They failed. That's normal. Then this should be support. It should come back if the markets allow. And then right here, the second time around, they will get enough oomph to break through. And then technically, they should be able to try to fill the gap. I say try because anything from here to here is going to be met with a lot of selling from volume profile. Mumbo Jumbo saying it won't be easy to finish filling the gap. And the first step is to cross 52. That's all you need to know. 52. Of course, to do that, you need to hold support, and 52, go above it. Then you start bursting in there, but they're going to be tough slog. Now, second point, looking further ahead, if it goes above 56, I think it gets to 60, maybe even higher, fill that gap. Now, it needs the market to do its thing, and it is in the hands of the sellers, so I am just putting the cart before the horse. Back to the question. They own shares at 51.40. How can they sell covered calls? Step one, what the heck is a covered call? Again, this is not a trade alert. This is not a trade recommendation. This is a lesson on covered calls. This is a options chain. This is E-Trade practice account. I'm not recommending the platform. It's good for demonstration purposes. Intel is the stock. Today was down a little bit. And these here are contracts that expire at different times of the calendar. We have one that expires in 3 days. 1 day, I'm sorry. Today is 11/11. And next week, the week after, the week after, the week after, middle of December, middle of January, middle of February, middle of March of next year, out to 2024. These are called leaps up here. Okay, so what level to choose? I'm going to jump into December, and they paid 51.40 for their shares. That's an important point. So what is a covered call? Let's go. What is a call? This side are calls, call. This sides are puts. So we won't talk about puts right now. We're talking calls. What is a call? A call is if somebody wants to buy Intel shares at 55. And they don't want to buy the shares right now, but they just want to lock in the price. So what they can do is they can buy a call. And the way to do it is they go in here and they say, I want to buy 100 shares. They buy one call. Every call contract is 100 shares. So they want 100 shares, they buy one call. It cost them 31 bucks, 32. It's around $30 to lock their price at 55. So anytime in the next 36 days, they can call the favor. Somebody who sold the call is on the hook. They promised they would give me, the buyer of that call, 100 shares at 55. Price does not have to be at 55 for me to call them on it. I can call them on it anytime. I'd be an idiot to do it when the price is 50. Why would I want to buy it at 55, right? So logically, that's why people say price has to be. It doesn't, but it's stupid not to be. Right? I've never seen it happen otherwise. So if price goes to 60 in the next 36 days, the person who sold me this call is obligated to deliver me shares at 55 at my beck and call. I would decide, I call my broker, hey, I own a call at 55, exercise my right. What does that mean? It means that the call I bought will disappear out of my account. I paid 30 bucks for it. It goes away. In place of it come 100 shares of Intel shares at a cost basis of 55. In reality, my cost basis is 55 plus 30 cents because I locked it in with 30 cents. But I'm profiting above 55.3. What happens on the other end? Where did those shares come from? The person who sold this call was forced to bring me in 100 shares of Intel. Okay, so they sold a call in Intel. I bought the call. They're on the hook to deliver me shares. I'm making an important point. If they don't own shares, they have to go out and buy them in the open market after the spike. So if Intel goes to 80, they lost a crap ton of money to make 30 cents. That is an insane amount of risk to take. In fact, what's the number one rule of risk taking? I'll give you a second to think about it. I'm pretty sure you said, know how much you can lose. You don't know how much you lose if you sell a call in shares you don't own. If you short the stock outright, which is what this does, you promised you would bring shares at whatever, at 55 price, and you don't own the shares. So you're essentially short the stock at 55 because you have to deliver it at 55. So if the risk profile of shorting a stock in open market like this is unlimited, infinite risk until you buy it. So to cover your short, that is not a good situation to be in. I forbid anybody in my family to do it. If you're watching, and if I hear of you doing this, I'll come slap you on the hands. That's how people went bankrupt if they shorted GME earlier this year. They went bankrupt. There is no way around it. Your account will be liquidated if it goes up 400%. You're just toast. So selling a call without owning shares is a no-no. No one should ever do it. That's called selling a naked call. Naked meaning I sell a call and I don't have anything to tie it to. If I own shares, like this person who asked me the question, they have shares. They can sell a call and it's called covered because they own the shares. So if Intel goes to 80, they don't have to go buy it at 80. They already own shares. All they have to do is just deliver the shares. So let's go through that scenario. They bought the shares at 51.40. Intel went to 65, 70, 75, 80, 60, wherever, above the sold call. What happens? So they profit from 51.40 to 55. Then I wake up and I see Intel, the buyer of the call, at 75. I'm like, whoa, crap, I'm glad I paid $30 to lock up my price. That's the person that bought the call. They call their broker and say, exercise my right, please. And then they will find 100 shares of Intel in their account at 55, even though the price is way up there already. So what happened on the other end? Where do those shares come from? They came from the person who asked me the question, who sold the covered calls at 55. So let's go through their logbook. They bought the shares at 51.50. They sold the calls. They got 30 cents for it. So 30 bucks went into their account per 100 shares they committed. And so they get the profit from 51.40, their price, to 55, the price where they they delivered the shares at. And after that, they're not on board. So they didn't lose money. They just missed out on more profits. So their profits would be 51.40 minus 55. That's the difference they made. They profited from 51.40. They got a nice rally. They got out of 55. That's all it means. Plus, they get to keep however much money they collected from selling those covered calls. So the worst case scenario of a sold call, a covered call, is profits. Less so than if you didn't do it, but it's still profits. Therefore, I personally would never ever sell a call I cannot deliver. So if the person was not intending on delivering the shares, they were just trying to eke out 30 cents, they're making a mistake, because in that scenario, they will panic. I guarantee you that they will panic, and they will buy it back at $3, because that call, if the price rallies, will increase in value. Look how expensive they become. So if price indeed rallies to 75, that 30 cents could turn into $10. So they have to pay $900 to close the $30 crap they collected in the beginning, because they don't want to, quote, lose their shares. Okay, so that's not a good situation to be in. If I sell a covered call and it spikes through, most often I would just, okay, I promised, here are my shares. I can turn around and buy the shares if I so much love them. Now, if I cannot sell them for practical reasons like taxes or whatever, then I shouldn't sell the covered call. I should avoid it. So now we talked about what is a covered call. We defined a call. We defined who can sell a call, never naked, but yes, covered. Then who can, which ones to choose. So Intel is not a very exciting stock, so at least not per options. So this one has 1 day on the clock. Today is Thursday. Tomorrow this expires, but there's not 9 cents. I mean, I don't want to sweat the day for 9 cents. So next week, like 8 days on the clock, still not a lot. So if I wanted 30 cents, I would have to go to 51.50. That would take me out of the stock, because their entry price was 51.40. So the very slim profits, but it's doable. 1 week after that, so now we're talking 15 days on the clock, I can go up to 52.50. So now it's more doable. And it's very important not to have an event. Like, there's no earnings here. They just reported. If there were earnings here, I would want different parameters. So that's a covered call against shares. They own shares. I chose to buy calls when I said I'm going long Intel. I did not buy shares. What did I buy? I bought December 52.50. I paid under 40 cents for it. Under 40 cents. I'm going to round and say I paid 40 cents. And then the move came. Boom. The 40 cents turned into $1. So I more than doubled my money. So what did I do? I could have booked it, but I liked the chart. And I knew it was going to hit resistance, like I showed you on the chart. So I said, let me try to take advantage of that resistance. So as it got into the area where I thought it was going to hit resistance, I sold a call against it. So my call today is valued at 75 cents. I paid 40 cents, remember? So I still am at double my price. I'm still at doubling my money. So what I did is I sold the November one, which expires in 8 days. Let me see here. This one, 53. So I collected 20 cents for it, which was pretty aggressive because I only paid 40 cents for the one I went long. So I was trying to cut my entry cost in half. So as of today, it's only worth 10 cents. So I can literally buy it back for 10 cents, and I would have made 10 cents out of thin air because I sold a covered call against my asset. My asset is the call I bought. So that one right there at 52.50. So I sold at 53 on purpose. Why? Because the worst case scenario would be me profiting but locking my profits, and I was totally cool with that. So I'm long at 52.5 per my bought calls over there, and I'm short at 53. So I have a little bit of margin, and not to forget that I already profited 40 cents and this extra 20 cents from here. So I was totally okay with it going to the moon and me missing out on the extra money I could have made. All right. So now if this dies in my favor, I can repeat the process for the week thereafter. But I have a feeling that I will know sooner or later, maybe tomorrow, maybe on Monday, to close the whole thing and book the profit altogether. Meanwhile, this is covered call. So it works on shares and owned calls, because if I own a call, I in essence own the right to buy the shares at that call. Remember the definition of a call? So if I bought the December call at 52.50, I own the right to buy the shares at 52.50, so I can sell covered calls. I'm not selling naked calls. If they say, well, you owe us shares, like, oh yeah, no problem. I own the right here. Let me transfer it into shares for you. So it's doable. It's totally safe that way. Okay, so now we went through all of this. Things not to do. Reminder: never sell a call you can't honor. Another reminder is if some people cannot fathom seeing a stock run without them. So those are the people that panic and they buy the call they sold back for a loss, and it just creates all kinds of messy situations. So this is hopefully walks you through the entire process of A, what is a call? B, what is selling a call? Never sell it naked. What naked means. Rewind and find it. And selling a covered call, why isn't it that dangerous? Because it tries to get me money while I'm waiting for my play to develop. I can do it against shares, and I can do it against actual calls. So if I do it against shares, remember, every contract in here, calls or puts, represents 100 shares. So if I sell one call, I better own at least 100 shares. And I don't have to do all of them. So if I own 1,000 shares of Intel, I can choose to only do 5 calls. This will commit half my shares to be sold away from me if Intel rallies. Compromise. Hopefully that all helped. Nick signing out. Again, this is not a trade alert on Intel.